retail sales numbers are on balance weaker than expected. For more on all of this, let's bring back Nadia Lovell. Nadia, thank you, first of all, for sticking around a little longer today. Your insight is extremely valuable for our viewers. What do you think of these numbers?
You know, that is an encouraging number on CPI coming in line with expectations. So it is showing that we're getting that step down again year over year. You know, the first quarter might have been a bit of a hiccup. And so markets are moving on that because it does allow the Fed to give the Fed that room to be able to cut in September in line with our expectations. And I think when you look at the overall macro picture, the fundamentals still remain intact, and we had a pretty solid earnings season with companies beating expectations, and we're seeing upward revisions to forward guidance. And so you have the corporate fundamentals intact, the economy still growing, and inflation is starting to show signs of being on that disinflation path again. Of course, we have to parse through the details on the core CPI to sort of see, you know, what's going on with shelter and what's going on with auto insurance. If we can make some more progress on that and step that down, then that puts the Fed in a better position to be able to cut. So overall, I think it's good news for the markets.
I'm looking now at Bloomberg News' article on this release. I'm seeing that shelter and gasoline accounted for over 70% of the increase in the consumer price index basket. I'm not seeing a lot beyond that right now. I'll do my best to come up with some of the details beneath the headlines here. But this is the first time in 6 months that core inflation in the U.S. has decelerated. You take that as evidence that, as we talked about it in the first conversation we had this morning, that U.S. inflation is on a disinflationary path.
Yes, I mean, if we can get back to, you know, sort of that 20-25 basis points month over month pace that we had in the second half of last year, that will be putting the Fed back towards, you know, getting inflation down to towards 2% in coming years, and being on that path to get core PCE to that 2.6% that they want to see by the end of the year. And if you have that in a combination with a labor market that is cooling, we saw wage growth also cool in the most recent payrolls numbers. That dual mandate that the Fed has seems to be able to be accomplished. And so monetary policy is sufficiently restrictive, and it feels like it is time to start to dial that back. I mean, the soft landing is in sight. We are seeing some weakness in the soft data. We, you know, ISM, manufacturing and services PMI dipped back below 50, the 50 mark line. We are seeing some commentaries in the Beige Book also pointing to weakness. And so that's what the Fed wants to see a softening, but not a drastic deterioration in the economy. And we are on that path to that. And so it does feel like the Fed can be able to deliver at least those two rate cuts that we expect to see. And if you see any sort of further softening, we could get a bit more. And that's great for risk assets.
Okay, here are some of the numbers that you were interested in. I'm seeing shelter cost rose by 5.5% within the CPI basket in April of 2024. That is a year, that's versus April of 2023. Shelter rises by 5%, rent rose by 5.8%, and transportation services rose by 11%. Those were some of the big upside movers in the release. Some of the softer numbers, some of the numbers contributing to moderating inflation. Dairy and related products came down by more than 1%. Energy, motor fuel, gasoline is a big one, of course. Gasoline rose by 1.2%, so much weaker than the overall number of inflation. All of the fuel categories showed modest increases compared to the headline and core numbers. New vehicles, the price of new vehicles contracted by 0.4% as well. Any thoughts on those numbers, Nadia?
That's encouraging in terms of like the continued disinflation that we're seeing in on the good sides. We know the used car prices declines that had been helping, and now you're also seeing new car prices also continuing to decline, and that's partly due to we're seeing better inventory, pickup and production as well. And so you should continue to see disinflation on the good side. Shelter has been sticky, but as we noted earlier in the segment, we do expect shelter to start to ease just given the pipeline. We know that there's a lag effect on shelter, and given that we have seen some softness in some of the new leases data, that should start to filter through in coming months. And the Fed is aware of that there's some delay in shelter being the shelter sort of moderating from here. And so overall, it feels like there's enough there for the Fed to start to increase confidence. We'll need more data because obviously Q1, we had 3 consecutive months of what was considered elevated. So it feels like we need 3 months of additional, so 2 more months of additional data for the Fed to remain, to gain that confidence in the disinflationary path. But so far it seems like we weren't too distracted from that path as a result of the bumpiness we saw in Q1.